Welcome back to the trading tree. With that being said, I think it's a good segue into the dip and rip thing. So, marked OPTT, those are swings for me. When you're playing a swing, I've talked about free shares. You don't have to lock in free shares. I discussed that with Elmo on the OPTT swing, for instance, SNDL. So it's a good example. Keeps going down the 60, 65 range every now and then. So that's a really good support level. And then it bounces back up. It actually stayed in that range Friday, wrote that too. So I lowered my ad zone on SNDL to 60 to 62 cents due to the consolidation below 65 cents. So I'm still long on that. But in that case, with SNDL, it'll spike up to maybe 68 cents and then spike back down to that 65-cent zone. So it's been consolidating for a while. So that's really a good spot for me, at least, to play those spikes, to lock in free shares. So I'm going to buy it at 60, sell it at 70 or 68 or 65 or 66, whatever. Lock in those free shares, buy it again, back down 60, keep on locking in free shares. The difference with OPTT and another way to play a swing like that is when it's consistently rising. So say you took your entry at 285, which is what I took my entry on OPTT, and I'll actually explain. You can see my pattern that I've highlighted and why I don't think you should buy it right now. Just looking at that chart, you should already know why I'm going to tell you should not buy that stock tomorrow. Anyway, we'll talk about that in a minute, but basically with OPTT, I got in at 285 on January 15th, so see right in here. So as you can see, it would dip back, it came back. If we actually looked at the 4-hour chart, the 15th. So there's plenty of opportunities to basically do what I just said with SNDL, buying dips or and then selling, locking in your free shares. But the difference here, for me at least, is how far I am above my average when I'm playing that dip. So I played a dip again at 310 and 330. So 310 right here on this, right at the open morning panic. Classic place to look for a dip, but I added to my position. I didn't lock in free shares anywhere in here because I already told you I thought it was going to go 100%. So I'm not worried about that. Now, if it dipped here and it dipped back to my open position, I would probably think about it, the next time I run a spike to lock in some free shares. Just because it's not doing what I thought it was. It didn't dip below my support zone, which I talked about at 260 actually. So I would actually added anything if it dipped down to 260. I knew it was going to run, which if you look at that daily chart, you could tell it was going to run. It was just a matter of when. But if you played those dips and you're well above your average, you're increasing basically at that point you're increasing your stop loss. But say I added on this 310 and then it ran, I could have easily sold at 350. I mean, that's a great sell right there. Lock in free shares. It consolidated and I added at 330 again on this one. So there was no reason to lock in any free shares or anything, and the adding, it's well above my average still. My average was with 310 and 285. I'm way down here on that. This dip looks great to me. So yeah, added there and ran. I didn't add here. I could have added in this dip, definitely. So I kind of missed out there. But either way, at this point, with what I'm about to show you is a good reason to possibly sell right here, like the entire position. Go ahead and just liquidate it. lock in free shares if you want, because at 285, I don't anticipate it to dip back below that. So what I warn you about OPTT here is just, you can see the pattern. It actually did it here. These are mini spikes, and it pulled back because of these bigger, larger spikes. They look so small, but it's kind of the same idea. It would spike and then pull back pretty hard. So it spiked here, pulled back. I haven't drawn wedges here, but these are wedges that form once you have a consistent trend line. So in this case, it never actually bounced. So I wouldn't even say that wedge formed to where you could have drawn that trend line, but it bounces on the top. So you can draw the top trend line of that triangle. And if you drew a top, but this is how I drew my mark to look at. I'm probably going way over anticipated. Why did that not? But God, why is that not selecting? Oh, I gotta actually click. But if you draw a top trend line, and then you just draw a line from the bottom to intersect with that top trend line on current price, it's gonna form a wedge. And that gives you an idea of when something might break out, along with our squeeze that we've talked about. No, get off of me. Our squeeze that we've talked about. The wedge is a really good sign of when something's going to run again. So I actually anticipate OPTT, unless there's a political thing that comes out and just runs the stock more, I anticipate it to come back to 350, $4 zone. That'll be my next ad. I don't think I'm going to sell anything because I don't anticipate it dropping anywhere close to my average. So I really don't have any reason to sell or lock in free shares. I mean, even if it dropped to, 330, I could still lock in free shares there and have a bunch of shares for when it's going to spike, because it's going to spike again. This is going to continue. This is a clean energy company. So this run here is just going to continue. It just has this weird pattern that it likes to run, which is actually very beneficial if you can take advantage of it, which is why I took a 285. I just saw this wedge, the wedge here that goes in that, it goes in that triangle spot. It formed. The high, once it bounced here, I've got a confirmation of my triangle at that point. So now I know on the trend line, I already have a trend line here that it's following. So I've got a clear confirmation wedge, and was just a clear sign that, hey, this thing is ready to do exactly what it did already twice. It was a much smaller, if you want to count this spike, actually, you could, because this is a wedge right here, where it ran here. But kind of what Mark did. Then you still have a triangle here before that big spike up. So play the dip, not the rip, because if we call something out and it just rips that next day and you're buying in at 302, you're still in good for our swing, right? But you could have been in a lot better. And this is not our swing way down here. That was just an example. I wish I got into the stock down here at $1.27. I wish that was yes. I wish that was like your PEIX play. Well, should have been like your PEIX play had you held it or played the dip. All you had to do was play it right. It wasn't a matter of you holding it. It was a matter of you playing it to where selling it wasn't really your top priority. You could have, all those spikes on PEIX, you could have locked in free shares. This was kind of before we even
knew what I knew,
started talking about it. But yeah, you could have locked in free shares, and it had plenty of time to lock in more free shares. And that's the beauty with go back to 5 days. Yeah. That was the beauty with this play on OPTT. If I really wanted to, I could have played so many dips, you know, but I just didn't want to play with it on my liquidity that way. But there were a lot of dips and rips that I could have played for just 5-10% locking in free shares every single time, especially if you're able to, you know, trade against the PDT rules. You're beyond that zone. You can just play dips all day long. If you've got that kind of conviction, something's going to run like, yeah, you know, play the dips and add to your position over time. Lock in profits whenever you feel like you need to lock in profits. Like I said, with OPTT, I'm well above my average. I'm not worried about locking in profits. Whereas with SNDL, when it pulls back, I'm at my average. So that's why I want to lock in profits every time. And I'm locking in free shares, and so I'm not really worried about it anymore as much. You know, it's technically a profit at that whenever I sell it. Doesn't matter when I sell it, it's still a profit. So that was really long about what we talked about. I actually wanted to show Mark real quick. I'm going to. It's the same kind of trend. I've actually used, which ones are these? Fibonacci trend line. So these are Fibonacci trend line extensions that I've posted here. And that's kind of how I get the idea of how it's going to run next. But it's also squeezing harder. As you can see, the triangle's getting better. The last two triangles, actually every triangle steadily got better. And this thing's going to explode, in my opinion. It's nothing to do whether that I'm holding the position, so just keep that in mind. I am holding the position. I'm holding large on the position. I'm just telling you this chart looks like it's ready to explode. Doesn't matter what stock it is. This is a beautiful chart. You see these triangles, and each one is where I've got the trend line extension. So once it creates a trend line, I've already known that now this trend line was actually way up here. It broke down below the trend line here. I wouldn't even have played this thinking it was a spike right here, because it just broke below your price trend line that it was currently in off of earning. So I would not have even played if I was not in mark already at the time. I would not have played anything. But using the spike and using that extension off the trend line, now that you know that the trend line is actually straight along here, that green line that you see at the bottom, once that's confirmed, once it bounces back and forth, some people like to say 3 times. I'm fine with just 2 times for it to bounce back and forth. Then I'm using those extensions to judge how far it's going to spike. I could do that with OPTT when it's going to spike again. It's not ready to spike, but once it does, you'll be able to form the same triangle wedge and know when that thing is going to spike again. If it pulls back, OPTT this week, if it pulls back just like I think it might, look for that wedge. If you don't want to get in right away, look for that wedge and play it that way. But these Fibonacci extensions, you'll see that each time, so this time it ran all the way to the blue, the top of the blue and red line right here. That's a really large run on a Fibonacci extension. Usually they only run like these percentage in here. That's where most people would take their exit. And that's why you actually probably get a sell-off right here. See it spike, sells off. That's because a lot of people take exits, that Fibonacci extension. But it continued to run. Now, same thing, it wedges, it runs that Fibonacci extension into the blue this time on that spike. It doesn't quite get up to the top of the blue or into the orange. Wedges again, you run that same Fibonacci extension from the top of that off of the same trend line. It's using the same trend line for the bottom of the Fibonacci extension every time. And it spiked all the way into the red zone this time, or orange, whatever color you want to think. and that was on a much shorter triangle. And so I just have this feeling that this really short ascending triangle is just going to spike into the red once again, which will be into the 340 zone. I'm happy with 3. I'm happy with 340. My price target on market's 4, always has been. There's a lot of people out there thinking much higher than that now. Share care, IPO, all that nonsense, but who cares about that? You want to play that chart, and that chart is beautiful. That's a 45-minute time frame. You can look at it a 4-hour time frame. It still looks the same. Beautiful chart. But you can play dips. If you were going to swing mark right here, I'm stupid. I could have been playing mark this whole fucking time on all these dips, rips, all that nonsense, and probably been a fucking millionaire by now. Because it runs. I mean, all of these. If you bought on any of these dips and just sold it on and locked in your free shares, this would be a perfect free share one, because it's running, consolidating, and you're just locking in free shares the whole way. Boom, locking in a lot of free shares on that spike. But you're still, even on these dips, you're still locking in free shares on these when it's downtrending. And that's what we mean by play dips, not rips. As far as whether you lock in profits or not, or continue to just hold position, that's all up to you. And one thing about the trading floor, if I tell you I'm going to take a swing, I don't know about how Spaz or Kermit, I mean not Spaz, Elmo or Kermit are going to play theirs, but I'm not going to tell you when I'm buying a dip. I expect you to watch shit on your own and figure out your own dip. So I'll tell you when I'm taking an entry. I'll tell you why. I'll tell you what I'm doing, what I'm thinking, where I think it's going to go. It's up to you the rest of the way. You don't even have to trade it. I don't expect you to trade it. If you don't like the chart, if you don't like your setup, that's awesome. That's what I want. I want you to look at it, make your own, and be able to have conviction judgment on what we're talking about. Play dips, not rips. So, if you ever wanted to know why a stock pulls back after, that's why. What you're seeing on that screen, the Fibonacci retracement and Fibonacci extension. There are so many people that use that to find their sell point. If you're wondering why stocks pull back all of a sudden, it's not just resistance at certain levels. It's that.
Good to know.
So many people sell at like the 33% and then the 62%. Those two, basically 1/3, 2/3. You're going to see people sell at those zones. Always.
Take note, you do have Fibonacci retracements, which is what you're seeing on my chart. Then you have on TradingView, they consider it trend-based fib extensions. On ThinkOrSwim, it's just Fibonacci extensions.
And that's actually different. The Fibonacci extension and trend-based extension is different. So they don't actually have a true
Correct.
Fibonacci extension.
Retracements are actually a 2-point, where the extensions is a 3-point. They are completely calculated differently as well. If you don't know the difference, I do recommend looking into it. We will cover them a little bit more in depth in the future. But either way, I use them more so than I have in the past with my swings now, just because it gives you a better picture. Especially finding those support and resistance levels, because it is going to hold to those Fibonacci ratios.
Yeah, it's gonna sell off. It's gonna be a good point to like. It doesn't always mean you need to sell. It just means don't get scared. If it does sell off a little bit, hey man, people are selling right here. Let me give it a second. See if it'll keep running. Maybe it won't scare you out so much. Or you see it sell off and then it breaks, it continues to break down. Then yeah, get out. It's gonna break down. it's going to actually bounce off that retracement. Yeah, I mean, that's the beautiful thing about all these indicators, is not necessarily that you need to clog your chart with all these indicators. I don't do that. The chart that I'm looking at on a daily basis doesn't have all these Fibonacci retracements and extensions and all these drawing lines. Sometimes I'll put these drawing lines if I'm trying to show you guys, like the NOAV play that I played. It's actually in the trading floor too. That was I'm actually going to explain that play.
If you noticed, I did click off on one of the Fibonacci. I didn't actually remove it, but that's one thing that I really like about TradingView is the customization on charting tools. But you actually can hide just by hitting a little eyeball once you have that indicator selected, indicator, drawing, whatever it is. You can actually hide it and then come back to it. And I haven't used it enough on on desktop that I don't know where it went to right now. And I'm still new at using this, but it's somewhere in here. It's still saved. I just got to figure out how to get it back on. But that is a nice little feature. So if you don't like cluttering up your chart, you want to have your drawings but not lose them, that is a nice little feature to have as well. So check out. You don't get to the second live charting. It's down to the minute, whatever time frame you're on. So it's going to update on that time frame if you're on the free service. But it's a nice secondary charting to have.
So anyway, when I talked about the NOAV the other day, y'all couldn't see trading, so it didn't really matter. But I made the mistake of, in trading floor, I put a lot more information because I did post them to the general chat as well. But all I did was post these wedge charts that I took screenshots of and drew the wedges on. But in the trading floor, I mentioned that, hey, this is a risky play when I first posted it, because it wasn't quite a, ascending, like a big ascending wedge. So it makes it a real risky play. But it broke out. I actually posted that on the trading floor. It broke out from that wedge. So that play right there on that wedge, if you're in right here, you're still holding. But if not, you're not. I mean, you could take an entry on this confirmation, I guess, which would have been fine. But I guess the main play was the next day. The wedge. This is the wedge that I posted the last, basically at after hours. So that's a beautiful wedge, nice ascending wedge. I had clear idea that it's going to go, so I said that. But I also mentioned in trading floor, I already have a low entry. In general chat, I didn't mention that. I didn't mention anything like, anything like that. Didn't say anything about it. Kind of forget that I forgot that I wasn't, trading floor. Y'all couldn't see it yet. So anyway, the point with a play like this, if I point out a wedge on trading floor or wherever like that, I'm playing that setup. So this particular setup, that's that wedge right here that you see on this chart. So that's this wedge here. All right, so that's the setup I'm playing. So now I already had a low entry because I got in these dips on the spike. So I had a pretty good low entry anyway. I wasn't concerned about it. But once it breaks out from this wedge, you're not playing that setup. So I just wanted to point that out. If I post something like that, it's not like one of my swings and I'm just posting, hey, this looks good. I'm taking an entry here because of this reason. Once it breaks out from that reason, you don't want to play that. So if you thought, hey, he's taking an entry on it for that reason, and then it's way up here in the 190, 180 area, and you take an entry on it thinking, hey, it's going to keep running, because I just called out OPTT or whatever that ran 100%. Well, guess what? I played this setup. I've already exited. I exited here. So you're taking a setup that's gone, and now you're stuck in a position that fades away to 130. Of course, hopefully you would have sold somewhere on maybe this spike. If not, hopefully this spike at the top, if you got in, or hopefully right here after it started to just drop, you got out right here. But I just wanted to make sure that that's, you know, if you understand the setup, if you're reading something that somebody else is calling out, understand what they're calling out, and don't just think, oh, this stock's going to go to fucking 50. This dude's calling it out. It's got some pattern. I don't know what pattern it is, but it's got some pattern going on. Because yeah, and that's the whole point of formulating your own setup, having your own entry, your own exit, your own reason to play it. You know, just for instance, if we did call out, say, we called out NAOV, I mean, it ran all the way through here, and we called it out here to take an entry on it. But you missed that. You missed that call out here at $1.25 or whatever, right before close. You missed that run. Well, guess what? You're looking at the chart and you see this beautiful wedge play. Well, all right. You made your own setup and you're taking an entry right here at $1.50. You're playing it in the morning. Hopefully you've got a 4 a.m. account and it runs to $1.90. Great. Awesome play, dude. So that's the whole point. And the whole point with the whole dips, play dips, not rips. So this would have been a great play. So we did call it out here. You missed it. Well, guess what? This dip right here is awesome. You get that dip and you could sell it right here for just fine. This dip is just fine. It's just a matter of how you play those dips, what the reason that you play those dips. You know, some people would play this dip just looking at level 2 or whatever. I don't have any other reason to take an entry on this dip. However, this one right here, yeah, it's squeezing for a long time right here. Momentum's up. I have a good reason to take an entry right here because there's a triangle that formed. So this would be a great entry point right here, which is actually when I called it on the trading floor, and it broke out from that. It's just patterns that you see. And so when somebody calls out something and you miss it, if somebody called it out right here, this is the news break or whatever the fuck, and it calls it out here, you miss it. Well, guess what? It just fucking wedged and formed a dark fucking breakout. So, yeah. Pay attention. You know, pay attention to charts. If somebody calls out a good play and it's got a lot of momentum, a lot of volume, a lot of movement, pay attention to charts, squeezes, everything we talk about. Make up your own shit. You know, go through these indicators up here. Go through these studies and just add them to your list and see what they do. I don't know, but figure out your own shit. And, you'll start finding patterns that just stick out to you. And that's what you like to play. For me, these wedges combined with a squeeze, beautiful. I fucking love it. Those are the perfect play.
Those Bollinger Bands and color channels sure are an amazing confirmation.
Yeah, man. Yeah, the Bollinger Bands, in case you don't have the squeeze indicator, a lot of these, this TTM squeeze that you see down here, it's only available on a few platforms. TradingView, ThinkOrSwim.
There's a handful.
Probably it. Yeah, well, yeah, there's a few
There's
others.
a couple more. I can't think of what they are right now because I don't use those brokers or
platforms.
platforms.
But if you don't have that, like Kermit uses Kermit J Frog. I can call him Jay. Jay's Kermit J Frog. He uses Weevil, so he doesn't have the squeeze, but he understands the squeeze. He understands the Bollinger Bands.
Baby.
the Bollinger Bands and the Keltner channels and how that seems to work. But basically, those gray lines that you see, that's the Bollinger Bands. Orange lines are my Keltner channels. So Bollinger Band goes inside the Keltner channels. It's squeezing. So this whole little consolidation zone pretty much squeezing. And then it fires off and you can see it break. That's the idea. But yeah, those wedges, the wedge combined with the squeeze, oh, thing of beauty. Let me tell you. Let me tell you. So, and that's why I say play mark. You don't have to. Don't blame me if it fucking tanks. That's for sure.
Find your entry. Find
your own risk, man. Set your risk. That's all I gotta say. Set your risk. For me, I have a nice low. In. So I'm not worried about risk right now. So you taking an entry on the wedge that's formed just now? Yeah. Just set your risk. That's all. You never know when something's going to drop an offering, and you don't sell on the offering. Average down on the offering, especially if you're paying attention. If you're sitting there right in front of the computer and the shit drops an offering on a position that you are currently holding, and you're sitting there ready to trade, play the fucking bounce. Play the bounce, and you're probably gonna make more than enough to cover your loss off that bounce. I guess it depends on how much liquidity you take to begin with. If you're taking full capital on positions, which you shouldn't be doing, then you can't play the bounce. You don't. Playing penny stocks with your full capital is offering and stuff like that. That just cracks the stock really hard, really fast, and you're not prepared for it, and you get out and you lose. You just have no way to recover that much. Whereas like a stock with even a penny stock with a lot of momentum, the offerings don't do as much. Blue chip stocks, the offerings do very little, if anything. So it just depends on what type of stock you're playing. But if you're just playing penny stocks, stuff like that, just random news spikers, whatever, an offering could really be bad for you. So I don't recommend taking full capital, or at least locking in those free shares, baby. As soon as you can, man. Lock them in. Lock them in and let it ride, baby.